Hey everyone, this is Corey with Sims Investment Management, and this is another monthly market update. And the market continued its upward trend in July. We were up a little over 2% on the S&P 500 last month. And there were a couple days with some volatility in there, but it's kind of in this ho-hum nature right now. Part of that driven by we started earnings seasons in July. For those of you that don't know, typically the beginning of every quarter, around the second week of the beginning of the quarter, that's when companies start to release their quarterly earnings. Public companies are required to tell their investors what they have done for the previous quarter. And typically banks kick that off, usually again starting about 7 to 10 days after the quarter close. So the market gets a little excited there for 4 to 6 weeks while a lot of companies report their quarterly earnings, and then things tend to maybe settle down where there's not as much news later in the quarter, starting about, it'll be about the middle of August to late August until the end of September. You'll get some straggler companies in there like Nike and FedEx late in the quarter, but for the most part, you get a big chunk of your earnings season early in the quarter. So earnings have come in very robust, great. Of course, they're doing a year-over-year comparison from second quarter of this year to second quarter of last year, which had COVID in it. So numbers look really, really good naturally because there was a low bar, a low hurdle to get over. That being said, companies continue to talk about how they've been able to navigate the supply chain issues and how they're correcting that, employees working from home and what they foresee there. Obviously, we're hearing about some companies pushing back when they're going to bring clients into the office. But for the most part, like companies are having tremendous growth. They are sitting their balance sheets, so what their assets and their cash look like compared to their debt, are the strongest they've ever been. Corporations really are in a healthy place. And I think that's really important to stress because, again, so many times I get this question like, well, the market's been going up, like it has to come down, and like it's not like gravity. It's not like what goes up must come down, right? The companies are real companies, they have real earnings, and the market is driving off of what they expect future earnings are going to be for those companies. It's not like a casino, which I think a lot of people think the stock market is. It's based off of true, real dollars and real earnings. And the other part of that is like not only are corporations in a really good spot, but individuals are as well. So if you look at debt servicing, how much the average American is spending of their monthly income on debt, we're around 8.2% of their income. This is down from 9.8% in the first quarter of last year. And it's not just consumer debt, like consumer credit cards that have been coming down. A big driver of that is the mortgage refinancing that so many people have been doing for the past year. If you haven't refinanced your mortgage, please reach out to us if you need an introduction to somebody. There's still really, really good and attractive rates out there, below 3%. So believe it or not, at 8.2% for income servicing debt, that's actually a 40-year low for Americans. It's tremendous. And it's well off the roughly 14% we were at in 08-09. So we have really healthy companies and really healthy, on average, consumer balance sheets, which puts us in kind of this Goldilocks scenario that the market's in right now. I'm going to shift gears a little bit, and I read this by a financial author recently, and he just posed the question in his article that said, are you being an economic child or an economic adult? And I thought it was really simple and really profound. Like so many times in our life, we can make decisions where we're probably being a child about that decision, right? Maybe it's emotional. We're being emotionally small and like a child instead of like an adult. And a lot of people manage their money that same way too. So I've been trying to keep that in mind when maybe talking with other clients, like, are we thinking about this from kind of a child's perspective, or are we thinking of it as an adult? I know there's plenty of areas where I need to think a little more adult-like and not be so childlike in my thinking. So I thought it was a good lesson and just a really simple question to get the mind thinking. I bring that up because I'm going to do another Teaching Tuesday video, and I highly encourage you to watch this. This is about the Robhinhood IPO. So Robhinhood is an app, very popular trading app that just went public, and in going public they had to release a lot of their data on like who their users are, how many trades they're making, what their daily metrics are. And it was really fascinating to go through some of this IPO information and see the gamification that people continue to use the Robhinhood app. The average Robhinhood user checks their account 7 times a day, which is absolutely insane. 7 times a year would be a lot. 7 times a day is absolutely unnecessary and insane, and probably causes a lot of the Robhinhood users to think like an economic child, to make knee-jerk reactions. So we'll talk more about that in the Teaching Tuesday video, but that's it for this month. If you know anybody that could use our services or enjoy seeing this video, please forward it along to them. Carter, quick Carter update. Carter is 6.5 weeks old and doing great. Emily's doing great, and we've been very blessed and very fortunate for everybody that's reached out and given us their support. So we'll see you next month. Thanks.